Pfizer is down over 4% today. This stock continues to plummet, down 43% year to date. But is this now an incredibly undervalued company? It offering a yield of over 5% right there at the 52-week low. Can we see this share price triple over the next few years and lock in a nice yield on costs that will go to double digits? We're going to take a look at the headlines as to why this stock continues to plummet. We're also going to look at their dividend safety, their financial metrics, whether or not this company is going to start to crumble. We'll analyze what the institutions are doing if they are buying or selling this stock, as well as comparing them to how the pharmaceutical industry as a whole is performing year to date, as well as the last 5 years. And we'll look at the health of the company, their balance sheet, total cash versus total debt. Do they have enough cash to keep this company going with COVID not being a main part of their top line anymore? And we'll also analyze their revenues, their bottom line net income, to see whether or not this company can continue to sustain its growth. And as always, we'll jump them in to our essential stock valuation model, getting to our intrinsic value and our acceptable buy price given our margin of safety. Now, down around 4.5%. The market is still open. It was down around 6% when the markets opened this morning, and we can see it does have a fairly decent starting yield. Now, if you're an investor of this company over 10 years ago, well, you would be down around 2.5%. Very poor, regardless of the fact it doesn't include those dividends reinvested. But we can see it was double this current price towards the back end of 2021. So let's find out whether or not this is a company that we should be looking into. Now, top line revenue, we do talk about this a lot. We do see it increase quite significantly from their 2018 number from 41 billion to 100 billion. Main reason for this, we do see it pop in 2020 due to COVID. So we do see, in fact, it remained fairly flat December 2018 to 2020, before more essentially doubling to 2021, and then around a 40% increase to 2022. And we can see the December 2023 figures soon to be released. The trailing 12 months showing that it will decrease quite significantly, but higher than the pre-COVID numbers. So we will take a look at that to see, and we will look at the last 10 years percentage-wise to see how the growth was before COVID. Now, bottom line, how does that compare? Well, 11 billion in 2018, 31 billion. Again, lots of growth on the bottom line as well as the top line. In fact, before COVID, we do see it still increase from 18 to 19, before decreasing in 2020, and then having a very nice increase to 21 and 22. But again, we see the trailing 12 months drop not only below the 2022 figure, but also below 2021, slightly higher than the 2020 pre-COVID number. So it will be interesting to see how the future looks, the forward guidance for this company for 2024 and beyond. Now, in terms of the health of the company, their total cash and total debt, based on their latest quarterly earnings, it has gone, their cash and short-term investments, from around 19 billion to 44 billion, so more than double their cash. It's not surprising. COVID was a very, very big hit for this company. As we can see, from 2021, their cash increased significantly, nearly 3 times as much, and they still now hold a significant amount of that as well. Total debt, well, numerically and directionally, what story does that tell us? Well, 42 billion. Now, whilst their cash has increased quite dramatically, so has their total debt, around 50%. So yes, they hold a significant amount of cash, but so has their debt also been increasing. And we'll touch upon that when we look at the net debt to EBITDA metric. Now, the pharmaceutical industry as a whole, we've got some examples here of competitors: AstraZeneca, Sanofi, Bristol Myers, Merck & Co. Now, year to date, Pfizer the worst performing, no surprise there, down 41%, and that includes those dividends reinvested. If you want to stretch back to 5 years, which we always recommend, the further the better, negative 19%, the worst performing. And in fact, in the pharmaceutical industry, it is the only company to have a negative return over the last 5 years. So do bear that in mind, but also remember, past performance is never an indicator for the future. And what we want to understand is this undervalued, and are there opportunities for this company to be a very strong value play? Now, 68% of institutional ownership, 11 billion of shares sold over the last 12 months. But look at that, more than 8 times more being bought, around 96 billion in the same period, with a huge 74 billion bought by the institutions in Q2 of this year. So we can see the institutions are seeing a large opportunity in their eyes to buy this company now. Do remember though, we're not looking at any of these institutional buys and copying them. We have to do our own due diligence. Now, before we jump into the essential dividend safety, let's have a quick look at their earnings from the last quarter. Well, they beat on the earnings per share. Yes, they expected negative, and it was negative, but to a lower degree. Surprise, well, a negative one in fact for the top line. They did come under by around 200 million. And on top of that, I don't think it comes as any surprise, but when we compare Q3 October 23 to Q2 22, they have had a much lower top line, bottom line, as well as earnings per share and both net profit margin and operating income. So this is a company that their top line is reducing, but maybe one that you could justify with COVID no longer being as big as it was, and therefore it does make sense. But we need to understand the opportunities that Pfizer has over the next few years to increase their top line, as we saw here. This needs to continue to increase, and we shouldn't be happy to see a very low increase moving forwards. And essentially what COVID has done, given them a large cash position. And what Pfizer have done with that cash is to buy lots of other companies rather than do organic growth, try and expand through acquisition. So we'll see how that plays out in their top line over the next few years. Now, before we jump into the dividend safety, we can take a look to see this article was released today and why the stock essentially went down 6% on already depleted share price. So they plan to discontinue their twice daily weight loss pill due to high rates of adverse side effects. Now, that can never be a good sign at all. So what they've essentially said is they will stop developing the twice daily version of their experimental weight loss pill after obese patients taking the drug lost weight had trouble tolerating the drug in a mid-stage clinical study. Now, this isn't great, and we can see the data is a blow to Pfizer. Their hopes to win a 10 billion slice of the booming weight loss drug market. And they did believe that to actually go up to 90 billion. So that is a big shame for them. They were expecting to break into this market, which looked to be lucrative for them. But we also have competitors in the industry like Eli Lilly, who are also looking into this essential industry, specifically the weight loss. So it will be interesting to see how this goes forwards for this company. Now, exactly as I mentioned, Friday's data puts Pfizer even further behind the dominant players in the weight loss drug market, Eli Lilly, Novo Nordisk, which are racing to develop pill versions of their blockbuster weight loss and injections. So it'll be interesting to see what now Pfizer plan to do. The stock has been hit quite dramatically. Will it continue to fall, or should we expect now for this stock to be at the bottom and to be an incredible value play with a dividend yield of over 5.5%? Now, dividend safety score 75, it's safe, market cap 172 billion, so it is a mega cap company. Now, when we look at some recessionary data, they did cut their dividend during the 07-09 recession, negative 6% sales, which was above the average growth of companies in the S&P 500, but do bear in mind that was also negative, but to a larger degree. They did outperform the S&P, negative 45 versus the S&P's negative 55, and in terms of dividend growth, well, last year, 2.5%, very poor, mediocre in my opinion. It is below the inflation rate that I advocate on the channel, always to get as a minimum 4%. But we are expecting an increase this month, so let's see. I am hoping for at least 4 to 6%. Last 5 years, above inflation at 4%. Last 20 years, above 4%, again at 6%, so not too bad. I would like higher numbers, but with a starting yield of around 5.5%, it isn't the worst. 12 years of consecutive dividend increases, and when we look at dividend yield theory, now this states that a company is undervalued when the current yield sits above the 5-year average, so we have our first sign of undervaluation. This is also the highest yield that has been offered by Pfizer over the last 5 years, so we see undervaluation. Bear in mind, we're not looking at any of these models in isolation. Forward PE, however, slightly higher than the 5-year average at 13.5 versus 12.1. It is also lower than the healthcare PE at 16.5, and we can see it right there at the 52-week low. But as I always say, 52-week low is never a sign for undervaluation, so do bear that in mind. Now, free cash flow below 60% is what we look at. The reason for this, earnings are susceptible to manipulation by management through accounting, and free cash flow below 60%, it does give us faith that management can offer those double-digit increases. 2022 came in at 34%. Now 2023 is expected to be fairly high at around 100%, which does mean, in my opinion, based on this data, we may not be willing, or we may not be getting a very high dividend increase, maybe similar to what we saw last year. Free cash flow per share, $2.38 in 2013, 464 in 2022, so it has nearly doubled over the last 10 years. But realistically, if you were to take out the COVID years, other than that, it remained fairly flat. So again, something just to bear in mind. It's really imperative that they do take a lot of the COVID cash that they received, really look to boost this company and move forward. Because as we can see also on the sales growth, 2013 to 2020, their top line really was performing pretty mediocrely, very poor actually I would say, and then COVID happened and we see some large increases, and as I mentioned, the trailing 12 months looks like this year's revenue will be a lot lower than the last year's. Now numerically this is how it looks: 51 billion in 2013, 41 in 2020, so in fact their top line was decreasing, COVID came and in fact doubled or more than doubled it over the last 2 years, and we can see the trailing 12 months looking to be around 68.5 billion. Now what they have done, they have returned excess cash to shareholders' pockets, 6.9 billion in 2013, 5.73 in 2022. So they are returning excess cash, but again, maybe we would like to see this at a quicker rate, especially given how hard the share price has been hit. It would be nice to see them to do some more share buybacks at a quicker rate. ROIC above 10% is what I like to see. Again, over the large part, to be fair, consistently around that 10% or more. The last 2 years, nice double digits, but unfortunately the trailing 12 months showing 5% is fairly poor in my opinion. Free cash flow margin and operating margin above 12% and 5% respectively. They do beat that, but do notice the trailing 12 months on both of them have decreased from the prior year, especially the operating margin. And with the operating margin becoming a lot lower, it does mean that bottom line in effect will be lower, and therefore we will see less dividend growth paid out. Finally, the net debt to EBITDA, still showing a fairly strong balance sheet, earnings before interest, tax, depreciation, amortization, and these signal the number of years it would take the company to pay off all of their debt net of cash on hand. 0.41, essentially saying that it would take them 0.41 years to pay it all off. Very good to see, well below the 3. The balance sheet looks to be strong, the dividend seems to be safe, although it is expected to come up very slightly in 2023, but still below that very high threshold we have. Now that is the analytical metrics. Now when we jump into the valuation model, and as always, if you enjoy the content, values being provided, smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And finally, before we jump in, if you want to grab a copy to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. Starting off with the Graham's formula, we have the stock ticker symbol PFE, earnings per share 183, growth rate per analyst estimates, and that current yield on AAA corporate bonds, given an intrinsic value of $35. Now we can see that is some nice upside to the current trading price at around 25%, but still within the 52-week range, showing signs of undervaluation. But as always, we never look at any model in isolation and draw our conclusions towards the end. We then have the multiples valuation model, companies in a similar sector and size. We analyse all of these on the 5-year total return. We have their stock price, earnings per share, PE multiple, average, multiplied by the earnings per share of Pfizer to get a stock price of $36. Again, some very strong upside to the current trading price, over 20%, but still within the 52-week range, showing signs of undervaluation in the current market. We then move on to the DDM model, where we have the yearly dividends, average growth rate coming to around 3.83%. Now I have gone pretty much bang in line with the average, but as always, if you grab a copy of the model, you can play around with these numbers. If you believe it to be higher, if you're more optimistic, or lower if you're more pessimistic, you can get your own price. Again, $40, nice upside to the current trading price, but still below the 52-week high, as all three models have shown so far some undervaluation in the current market. We then move on to the DCF model with our free cash flows year on year. Average growth rate at 12%. Now, forward-looking analysts are estimating a negative growth rate. Now, with the discount rate and present value of future free cash flows, we get the terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. Again, strong upside. The DCF price coming to $44, but again, not higher than the 52-week high. So we are seeing signs of undervaluation in the market, but not higher than what we saw on the 52-week range. Now, the intrinsic value is just the average of the models that we've run through. And again, if you enjoy the content, values being provided, don't forget to smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So the current price at $29 with the intrinsic value at $38. As always, we do start off with a 10% margin of safety if we believe the company has a wide moat, strong financial metrics, good forward-looking data. So if you believe that for Pfizer, it is a buy up to $35. At 20%, it is still a buy up to $31. And at 25%, it's roughly near enough the current trading price. So realistically, you are locking in now between a 20 to 25% margin of safety. What did Wall Street say? Well, they believe there's been some very strong upside to the current trading price, in fact, above the intrinsic value that we have calculated. So, whilst we are estimating between a 20 to 25% margin of safety on the current price, Wall Street believe there are some nice upside to the current value at around 30 to 35%. So let me know your thoughts in the comments below. Is Pfizer a company you are adding? Does the current news worry you about the expansion for growth for Pfizer and the company? Or are you looking to sell or have sold? Or if you're just on the sidelines, let me know what other pharmaceutical companies you have been buying. As always, if you want to grab a copy of the intrinsic value calculator to get the intrinsic value and acceptable buy price of companies in your own portfolio, click on that pinned comment below. And just if you enjoy the content, smash the like button, hit the subscribing bell so you are continually notified of these videos as they drop. And as always, I'll catch you on the next episode. Take care and have a lovely day.